I'll be going through with you about Yelp stock. Just type it in Google and click enter, and this information will appear. You can see the name of the firm, it's Yelp Inc., and the NASDAQ symbol is Yelp, YELP. And if I want to buy the stock right now, I have to pay 37.49 US dollars for one stock, and it's a billion size firm. So it's a big size firm, and it doesn't pay any dividend. I just want to point out about dividend yields, the importance of it. Any firm that is paying dividend, that means they're financially very, very strong because after paying their creditors, loans, costs, they still have extra money. That extra money it pays to shareholders as dividend. So any firm that is paying dividend, that means they're financially very strong. It's a positive news. And no matter how small the yield is, even if it's less than 1%, that's brilliant because that's extra money. This firm is not paying any dividend. There could be many reasons for that. That what you have to find out. Maybe it's reinvesting the extra money back in their firm to expand further. That's why it's not paying dividend to shareholders. So they're using that money to reinvest and expand further, or maybe there are other reasons, or maybe it's not financially strong, maybe, or whatever. So it's something very important part aspect to search about. Let's go to Wikipedia and see when was this founded. And I can see this box here. You can see founded in 2004, 14 years ago. And I want to see what reviews it has from its employees. Just copy this exactly from Google like that, paste it here, type in Indeed reviews, and sorry, click enter, and I'll just click this part, and I can see that we have 392 reviews and it's 3.6 stars. That's brilliant. And please read through the pros and cons yourself, and you can see the jobs listed, the photos of the firm and everything. And check this out in Glassdoor as well. That's brilliant as well, website for reviews. Click enter, and I will see that I can see that we have 2,300 reviews and it's 3.2 star. Read through the pros and cons yourself. Check out the jobs listed, the salaries they're paying, the interview questions, the benefits they're getting, the employees are getting, and the photos of the firm. Now let's go to just see a patent and see if this firm has any patents or not. Okay, and I can see it has patents. So please look at assignee or applicant because these are people who have full rights of the patent. And I'm just watching that in 2012 it has a patent, 2013 it has patents, and that's some other, I think, company that's not Yelp. Yeah, that's another one. So that's not the one we are looking at. So it has like 3 patents altogether, what I can see here on this website, and which is brilliant because the more patents a firm has, the more stronger it is in the market, and it's harder to beat that firm. And please look that do they have any recent patents, because that means they're still innovating. Do they have any patents in 2015, 16, 17, 18? Because that means they're still innovating. That's very important to know as well. Now let's have a look in Yahoo Finance and see that who the key executives are and what salaries are they getting. That's a very important question. So I'll just paste it exactly and click on the NASDAQ symbol YELP, go to profile, and then I can see the sector, industry, and the full-time employees. Okay, and what I can see is we have 5 key executives, only 4 of their salaries have been shown. We can't see a salary of one of the executives because it says not applicable. Now I just want to point out that the more transparency of salaries and the more information about the salaries we have, the more transparency there is and the more trust we are able to build. But I can't see one salary is missing. It says not applicable. It's up to you to find out why it's not applicable because I need all the information. Now let's go to macro trend and let's see the price ratios. Click on price ratio, price book ratio, and I'll just type in the symbol Yelp. And I just want to point out, if price book ratio is less than 1, that means stock is cheap, it's undervalued, it's a discount. That's brilliant. If it's more than 1, that means stock is expensive. The higher the number goes, the more expensive it will get. So it takes time to load. Sometimes this website is a bit slow because it has a lot of data, but it will make your life quite easy once loaded. So please be patient with this website as well. Okay, I can see right now that we have 2.8 is the price book ratio, which means the stock, if somebody buys the stock right now, recently in August 2019, they'll be paying 2.8 times more money to buy the stock. It's expensive. So if I just have a look in March 2019, it's 2.76, which means somebody bought in March 2019, they paid 2.7 times more money. So they paid $34 to buy something that was $12 worth, and right now it's more expensive. It's 2.8 times more expensive. And since we have data, I can see it's the most expensive in 2013 September, when it was 22 times more expensive. So people paid $66 to buy something that was only $2.98 worth. So it was 22 times more expensive. And that's fine. And I'll go to other ratios right now. And current ratio, I just want to point out, if the current ratio is less than 1, that means stock is risky because liabilities are more than assets. And if the current ratio is 1.5 or more than that, that means stock is safe because it has a good margin of safety. So let's have a look. Right now, I can see that the current ratio is more than 1.5. That's brilliant news. That means stock is very safe right now. But we just have information up till March 2019. But I can just see that it's more than 1.5, so it's a very safe stock. Let's look at the previous trend. Has it ever been below 1.5? That's my question. So I can see that since 2009 December up till now, consistently it has been above 1.5. So it's a very safe stock consistently. Now let's go and have a look in debt equity ratio. This ratio will tell me if the stock is mainly operating on debt or equity. I'm looking for zero point 0.5 or less than that ratio for it to be very safe and have a good margin of safety. Let's have a look. Okay, right now I can see that it hasn't taken any debt. It's mainly operating since we have data since 2009 December. It's mainly operating on equity. It hasn't taken any debt. That's brilliant. So, but just recently in March 2019, it took a debt, but the ratio is still less than zero point 0.5. That's brilliant. It means it's a very safe stock in terms of long-term debt. So that's brilliant ratio. And let's have a look at return on equity. I'm looking for 8% or more than that for it to be brilliant. Let's have a look. Okay, right now I can see that it's less than 8%. I'm looking for 8% or more than that. Let's look at the previous trend as well. So it's more than 8%. It's fluctuating as well. Then it's less. Then it's a minus equity. So I would say, like in terms of return on equity, it's not consistent in being 8% or more than that. So it's up to you to decide.